Sheetal was anxiously looking at her laptop sitting in her office. She was making some calculations. Her friend Pratibha asks her what is the matter. Why was she looking morose? Sheetal moans that she had invested in an index mutual fund last year. She has got negative returns. The 50,000 rupees that she has invested, instead of going up, it has actually come down. Pratibha asks her on whose advice did she invest in an index fund. Sheetal said her financial advisor Prashant Jain had said index funds were quite secure and the returns were also good. Pratibha asks Sheetal to ask Jain what kind of financial advice had he given. Sheetal then calls Jain and tells him that she had got stuck because of him. She said that on his advice, she had invested in an index mutual fund last year, but she has got negative returns. The 50,000 rupees that she had invested, instead of going up, had actually come down. Prashant Jain acknowledges that index fund gave negative returns last year. Jain advises her to remain invested in index fund. It would eventually give handsome returns one day. According to the Association of Mutual Funds in India, that is AMFI, net asset under management of index fund in the last 1 year rose nearly 184% to 1.29 lakh crore rupees. But during this time, returns of index funds have been very poor. Many funds have given negative returns.
To fully understand Sheetal's story, first of all, you should know what are index funds. If an investor invests in passive mutual funds, then he has two options. The first is index, while the other one is exchange traded funds, that is ETFs. Index funds copy an underlying benchmark. This means money is invested in the shares of an index in some proportion. For example, Nifty 50 index funds invest in companies listed in Nifty 50. Similarly, in case of Sensex index, money is invested in 30 companies of Sensex.
Investors can easily get the benefit of diversification in index funds in very affordable manner. By investing in one index fund, you can get exposure to dozens of stocks at one place. Index funds are considered to be one of the safest investment instruments. Apart from this, in comparison to active mutual funds, index funds also have lower costs. So going back to the conversation between Sheetal and her financial manager Prashant Jain, Sheetal cursed Jain that negative returns has shaken her trust in investing. Prashant Jain says that Sheetal will have to wait a little longer. She will have to remain invested for 3 to 5 years to reap rewards of her investment in the long term. Sheetal agreed that index funds generate handsome returns in long run. But she also asks Jain why index funds generated negative returns last year.
But in the case of investing in index funds, investors often make mistakes. Many people invest in the best performing funds by looking at historical returns of mutual funds, that is, returns of the previous year. If a fund performs poorly in comparison to Sensex or any other benchmark, investors panic and, in most cases, they even withdraw money. The truth is that index funds usually give lower annual returns than stocks, but the magic of compounding increases chances of making much higher returns over a period of more than 1 year. Apart from this, a major disadvantage of investing in index fund is that a passive style is followed. Therefore, there is less flexibility in it. In active funds, the fund manager actively changes the stocks of portfolio during a market downfall or any reversal in the economy. This protects the investor from various types of risks. But passive funds do not have such scope. These are inactive because these just follow the index and do not change the allocation of the shares. First, we will see what should existing investors like Sheetal do who are troubled by 1 year's negative return. Secondly, should the new investors invest in these funds? If you look at this whole story, Sheetal has committed 2 mistakes. One, Sheetal's first big mistake is that she put all her money in one fund, and that too in index fund. Any investor should have 4-5 schemes in the portfolio and divide the investment into debt and equity funds. If there is passive investor, then he should allocate major portion of equity portfolio in index fund. That is, overall, if someone has started 4 or 5 SIPs, then 1 or 2 SIPs should be in the index funds. Second, Sheetal was that she accepted Jan's advice and invested money in the index fund. But she did not understand the point made by Jan. She was upset to see the 1-year returns in the long-term investment instrument. But she was advised to remain invested for at least 3 to 5 years. So, overall, the thing is that if you also invest or are thinking of investing money in the index fund, then do not make this mistake. Do not put all your money in a single index fund. Choose different type of funds to build a strong portfolio of mutual funds with perspective of long-term investing.